Welcome to G Fun Facts Online. Have you ever wondered how a housing market slump in one country could cause a global recession? Or how the collapse of a single currency could send shockwaves across an entire continent? This phenomenon is known as financial contagion, the incredibly fast transmission of market shocks, from stock market crashes to currency devaluations across national borders. Much like a virus, financial distress can infect one economy after another, leaving a trail of devastation. Understanding how this happens is crucial for grasping the vulnerabilities of our interconnected global financial system. Today, we're going to deconstruct financial contagion, explore the hidden pathways it travels, look at three major crises it caused, and see what can be done to fight the fire. The term financial contagion really entered the mainstream during the 1997 Asian financial crisis. The collapse of the Thai baht triggered a domino effect across East Asia, even rattling markets as far away as Russia and Brazil. This event, along with the 2008 global financial crisis and the Eurozone Debt Crisis, taught us a stark lesson. In the modern economy, no nation is an island. So what exactly is financial contagion? At its core, it's the spread of economic crises from one market or region to another. This can be seen in the correlated movements of exchange rates, stock prices, and capital flows. Economists break it down into two types: fundamental-based contagion and pure contagion. Fundamental-based contagion, also called spillover effects, is the rational transmission of a crisis. Think of it this way. If a major economy like the United States enters a recession, its demand for imports will naturally fall. This directly harms the economies of its trading partners who sell goods to the US. It's a direct economic link, like a chain reaction. Then there's pure contagion, which is where things get more psychological. This happens when the movement of markets isn't justified by macroeconomic fundamentals. It's driven by the behavior of international investors. For example, if a crisis hits one country, investors might suddenly reassess the risk of an entire region or a whole class of assets. This can lead to what's called a flight to quality, where investors pull their capital from markets they now perceive as risky, even if those markets have perfectly sound economies. This is less like a chain reaction and more like a wave of panic. So how does a crisis in one corner of the globe actually go viral? The spread isn't random. It follows distinct pathways, both tangible and intangible. Let's start with the tangible links. The most direct channel is through trade. When a country's economy stumbles, its people and companies buy fewer imported goods. This directly hurts its trading partners. Furthermore, if a crisis-hit country devalues its currency, its exports become much cheaper. This puts immense competitive pressure on other nations, who might feel forced to devalue their own currencies just to keep their export industries alive. A major crisis can also cause a severe disruption in trade finance. That's the credit necessary to facilitate international trade. During the 2008 crisis, there was an estimated shortfall of $100 to $300 billion in trade finance, which was responsible for up to 15% of the massive decline in global trade. The second major tangible link is the interconnectedness of financial institutions. In today's global banking system, large, systemically important banks have vast cross-border exposures. If a major bank in one country fails, its creditors, which include banks in other countries, will suffer losses. This can trigger a cascade of defaults. The collapse of Lehman Brothers in 2008 is the textbook example. The failure of this single investment bank sent shockwaves throughout the entire global financial system, as institutions everywhere realized they were exposed to Lehman's failure, either directly or indirectly. And this isn't just about banks. Insurance companies, hedge funds, and other financial players are all part of this intricate web. But these tangible links don't tell the whole story. We also have to consider the intangible forces, particularly investor psychology. The famous economist John Maynard Keynes called this animal spirits. Behavioral finance gives us insights into how these psychological factors amplify crises. A key driver is herd behavior. During a crisis, uncertainty and fear take over. Instead of doing their own analysis, many investors simply follow the actions of others. If a few big players start selling, everyone else follows, leading to massive sell-offs that are completely disconnected from the actual economic fundamentals. This herd mentality can become a self-fulfilling prophecy, where the fear of a crash actually causes the crash. Another psychological bias is loss aversion. People feel the pain of a loss much more intensely than the pleasure of an equivalent gain. So when investors suffer a loss in one market, they become more risk-averse. They might pull their money out of other, even unrelated markets, simply to prevent any further potential losses. This portfolio rebalancing can transmit the initial shock across the globe. Finally, there's the concept of a wake-up call. A crisis in one emerging market might lead investors to suddenly scrutinize the fundamentals of all other emerging markets more closely. They might uncover vulnerabilities that were previously ignored, triggering a sudden outflow of capital from an entire category of countries. Let's look at how these mechanisms played out in three historic crises. First, the 1997 Asian financial crisis, often called the Asian Contagion. It started in Thailand in July 1997. After years of pegging its currency, the baht, to the US dollar and accumulating foreign debt, the Thai government was forced to let the baht float. It collapsed. The crisis spread like wildfire to Indonesia, Malaysia, and South Korea. Why so fast? These countries shared similar economic vulnerabilities, like large deficits and high levels of short-term foreign debt. When foreign creditors lost confidence in Thailand, they assumed the whole region was a bad bet and pulled their capital out. Trade channels also played a role. Thailand's cheaper currency made its exports more competitive, pressuring its neighbors to devalue their own currencies. The crisis was so severe that it required a massive bailout package from the International Monetary Fund. Next, we have the 2008 global financial crisis, the worst economic downturn since the Great Depression. This one started in the US subprime mortgage market. A housing boom went bust, leading to a wave of defaults on risky mortgages. The real problem was that these toxic mortgages had been packaged into complex financial instruments, mortgage-backed securities, and collateralized debt obligations, and sold to financial institutions all over the world. When these securities became worthless, banks in the US and Europe faced catastrophic losses. The bankruptcy of Lehman Brothers in September 2008 was the climax. It froze global credit markets and triggered a stock market crash. The contagion was truly global. European banks, having invested heavily in US subprime assets, were on the brink of collapse. The crisis also spread through a great trade collapse, as demand for imports in developed countries plummeted and trade finance dried up. The intricate web of the global banking system ensured the shock reached every corner of the world, leading to a global recession. Finally, let's consider the Eurozone Debt Crisis, which began in late 2009. This was a complex crisis involving governments, banks, and the unique structure of the euro. It was triggered when it was revealed that Greece had been drastically understating its budget deficit. This shattered investor confidence, and Greece's borrowing costs skyrocketed. The contagion spread to other Eurozone countries with high debt, like Ireland, Portugal, Spain, and Italy. A key transmission channel here was the sovereign bank nexus. European banks held huge amounts of government bonds from these struggling countries. As the value of those bonds fell, the bank's own financial health was weakened. This, in turn, put more pressure on governments, who now faced the terrifying prospect of having to bail out their own failing banks. The fear that Greece might leave the Eurozone fueled further panic. The crisis highlighted the fundamental challenge of having a single currency without a unified fiscal policy, and it took a series of massive bailouts to prevent the collapse of the euro itself. So in the face of such devastating contagion, who are the global firefighters? The international community relies primarily on institutions like the International Monetary Fund, or IMF, and the World Bank. The IMF's main job is to ensure the stability of the international monetary system. It does this through surveillance, where it monitors countries' economies to identify risks. It provides financial assistance, lending money to countries in crisis to help them stabilize, usually with conditions attached that require economic reforms. And it offers technical assistance to help countries build more resilient economic institutions. The World Bank focuses more on long-term development and poverty reduction, but it also plays a crisis response role. It helps countries identify vulnerabilities in their financial systems and provides financing during a crisis to support social safety nets and maintain essential public services. The history of financial crises shows us that contagion is an ever-present threat. Globalization has brought incredible benefits, but it has also created the superhighways for shocks to travel at lightning speed. Mitigating this risk requires a multi-pronged approach. At the national level, countries need sound macroeconomic policies and strong financial regulation. At the international level, we need greater cooperation to strengthen the global financial safety net and ensure regulations are applied consistently. For all of us, understanding the dynamics of financial contagion is key to navigating a volatile world. The fortunes of nations are inextricably linked, and a fire that starts in a distant market can all too quickly spread to our own backyard. Thanks for tuning in to G Fun Facts Online.